Good morning, everyone. This is Vincent, your economist. Today I'll be talking about Indonesia update. Yep. Okay. Sorry. Yep. So for Indonesia, as all of us know that on July 9th, Indonesians went to polls to choose a successor to President Susilo Bambang Yudhoyono, who will be stepping down in October this year. There are two candidates: the Jakarta Governor Joko Widodo, also known as Jokowi, and the other one will be a former military commander, Prabowo Subianto. Essentially, these two candidates offered similar proposals to boost growth, which is spend on infrastructure, rein in costly fuel subsidies, and as well as build up Indonesia's value-added industries, including to maintain Indonesia's ban on mineral oil exports. But the differences lies with their respective approaches, where Jokowi is to improve regulations to attract investment as well as cutting down red tape and corruption. However, his plans may be very populist, but budget constraints remain as a setback. Later, I will elaborate more on the budget constraints. As for Prabowo, his plan is to raise more money from capital markets and tax, as well as to spur economic expansion by doubling the rate of borrowing. His plan aiming for as much as 10% economic growth in a country where the central bank estimates GDP growth of less than 5.2% this year is relatively overrated. Okay, as of early this morning, Jokowi is actually leading Prabowo after 97.55% of total votes tallied from the election, with Jokowi securing 52.9% of the votes counted, according to a website that tracks actual results at polling stations that are uploaded to General Elections Commission website. Both candidates have suggested that the other was cheating. However, Elections Commission will still go ahead to announce the official results as per schedule by tomorrow, July 22nd. So candidates can actually challenge it in the Constitutional Court after the announcement, but which also will mean that weeks of further delays in formally announcing a new president. According to Reuters, some analysts estimated that Prabowo would need a change up to 7 million votes to gain victory. Regardless of whoever wins, in order to progress and reach sustainable growth, the next president will first need to create jobs and to reduce poverty. The economy will need to grow at an annual pace of 7% to create jobs, up from the 5.8% in last year. Due to budget constraints, as it is stipulated in the law that the fiscal deficit should not exceed 3% of GDP. Hence, opening up foreign direct investment and portfolio investment would be the key to boost economic activity. So fuel subsidies are actually among Indonesia's biggest budget expenditures. As you can see from this graph, it's actually at about 30.3% of government expenditure in 2012. Therefore, it would be necessary to cut fuel subsidies for the second time to provide the fiscal room for the infrastructure spending. With both candidates pledged to rein in fiscal deficit by cutting fuel subsidies, we expect measures to kick in soonest in early next year. On the other hand, we can see that the weakness in both budget as well as the current account, which previously pressured the rupiah to plunged about 21% last year, have no doubt actually improved after Bank Indonesia raised its benchmark interest rate last year. But despite seeing that there's an uptake in both budget as well as current account, the weakness in these two accounts have yet to be resolved. Policymakers have actually aimed to narrow current account deficit to 2.5% of GDP by end of this year from the 3.3% last year and towards 2% in next year, which will in turn provide a fundamental support to the rupiah. As mentioned earlier, a ban on mineral oil exports, as well as weakening coal and palm oil exports and lower oil production, could actually aggravate Indonesia's budget as well as current account deficits. Having said that, we also see signs that Indonesia is benefiting from a global cyclical recovery as trade balance rebound in May, while the ban on mineral oil exports would likely to benefit the country in long term. So to sum everything up, structural reforms 2.0 is required for the new Indonesia. The challenge will remain as how the new leader would act to close the gap for current account as well as to rein in inflation while deploying reform measures to improve quality of life as well as to raise productivity. With this, we upgrade Indonesia to overweight from underweight on bet on Jokowi victory leading to a cleaner and efficient administration, as well as we see that the reform story remains intact. Okay, for JCI, we have seen that the index has rallied 18.65% year to date, outperforming most of its regional peers, and currently trading at 20.49 times of its PE, slightly above its 52 weeks trailing PE. It's being valued at 16.35 times estimated 12-month earnings, with the consensus earnings forecast growth to grow at 50.86% year on year. So we also expect that there will be a near-term volatility post-election. So investors may book gains into potential market rally post-election, but reforms agenda as well as the timeline may limit the market upside. So for those investors who would like to invest in Indonesia, you may look into these mutual funds as well as ETFs. With this, I would pass on the presentation to my colleague, Colin, who will be talking about M1.
Hi, morning everyone. This is Colin here, and we just sharing some updates on M1, right? Since the the release of its first quarter results, share price has rallied quite significantly, about 8%, right? And M1 will be releasing its second quarter results today after market closure. So likely we will be reviewing our target price as current share price has kind of been reaching our previous target price, right? And just to share some update, our very likely it may likely be revised upwards as our target price are pretty conservative due to the following key upsides which I'll be sharing. First is we do expect further growth in the mobile services, which will be coming mainly from higher access data charges at $10.70 per gig, which M1 has already revised its access charges from a previous price of $5.05 per gig. So effective from 1st January this year, right? They will be applying the higher access charges, so you can expect further data monetizing from these subscribers on the post. Right, apologies, right, I will speak, right, I think we have some issue with the mic, so I'll be repeating what I've shared earlier on. Firstly is we do believe there's further upsides on M1, which may be supported by the following. Firstly, we do see further growth in mobile services, which will be coming from the higher access data charges, which is effective from 1st January 2014, right? Second is there's more room for further more subscribers that will be taking up the 4G tier plans, and hence we do see more subscribers exceeding their data allowance, which for the basic plan it's about 2 gig per month, right? And the third the third driver, which we're sharing more, which is also the main reason why I've said that our previous target price is pretty conservative, is that M1 will likely be charging extra on the on the 4G subscription plans with effective from next year onwards. If you have not realized, M1 has already updated their websites, stating that the free waiver of the 4G plans will be expiring at the end of this year, and hence very likely they will be charging extra on 4G plans following the increase of the revised charges that was executed by StarHub, right? So due to the intervention of IDA on the StarHub revision of 4G charges, right, this extra charge will only be applicable for new signups and recontracting subscribers, right? Second, we also do see growth in the fixed services that will be coming from increasing residential takes up in M1's fiber broadband offerings, right? As fiber broadband is new to M1. Previously, M1 does not offer the residential broadband prior to the announcement of fiber broadband. So hence, we do see M1 will continue to take market share away from its other competitors, right? And we also do see the demand from SMEs for higher speed broadband connectivity, as M1 will be increasing its penetration in this enterprise space, right? Of course, downside risk to M1 is that there could be a further price erosion for fiber broadband offerings due to the strong price competition from other players, as due to the non-listed players such as MyRepublic and ViewQuest. There's promoting on their broadband offerings very aggressively, right? And then the other downside risk, which is in fact it's a more bigger threat to the current incumbents, is the potential of a new competitor entry into the mobile telecom market, right? I believe if you have heard that MyRepublic did announce its plans to be the fourth telco, right? So if this is realized, right, we do foresee price competition in the mobile telecom space, right? And that will erode the earnings for all three telco operators, as mobile is mainly the core revenue in this industry, right? So next is Silverlake Axis. We have revised our target price to $1.32. Since the release of its third quarter's results on the 7th of May, share price has strongly rallied over 30%, right? And our previous target price was rather conservative, and I'll be sharing more on what will be the drivers that will support further growth for this company. First, we do see bright growth prospects. They'll be mainly supported by the consolidation, regionalization, as well as the digitization initiatives from ASEAN banks, right? Mainly, we do see that banks will be diverting their IT investment in the following key areas, which is firstly on data analytics, right? Second will be on a customer-centric focus on their business model. Third will be the stricter regulatory compliance, also followed by risk management, as well as mobility solution, as due to current technology trends, we do see banks will be expanding their channels in internet banking and more mobile solution, right, to capture more customers, right? So IDC Financial Insight also expects bank IT spending in Asia to grow at about 7%, leading up to 2017, right? As the banks will mainly be acquiring a more integrated software suite rather than a software system on a standalone basis, right? Also, earlier in we hosted a Silverlake for our Philip Corporate Day on the 2nd of July, whereby the managing director of Silverlake has shared that there's about 300 banks in the region are still relying on older and in-house developed software system. So this is a big potential market for Silverlake to capture, and they are confident that they are able to capture a large share, given that they are able to provide a core banking system that is able to support the large scalability and the operations, right? Key drivers for the growth of Silverlake may coming from post-merger integration projects, from the possible CIMB RHB merger, as well as the OCBC Wing Hang merger, as CIMB and OCBC are currently using the Silverlake Axis core banking system, and they are major customers of Silverlake Axis. Apart from that, we also do see there will be further upgrades and enhancement on the existing bank on their bank core banking system from existing Silverlake customers, right? And one key investment merit of Silverlake is that with every successful implementation of the banking system, Silverlake will be able to earn annual recurring maintenance and enhancement services from this customer base, right? Downside risk to this will be that the above mergers will actually will actually fall through, right? So if that's the case, then Silverlake will hence lose the opportunity of the post-merger integration projects. However, in our earlier report, we do share that the company is gunning for a major contract from RHB. So even if the merger does fall through, they still have the possible opportunity of capturing the contract from RHB, although the probability of that will be much lesser as compared to if the CIMB RHB merger was to go through. Also, banks are quite sticky with the current core banking system, so this will also will have Silverlake will also have faced the difficulty of acquiring new customers, right, to replace to convince them to change and replace the core banking system with the Silverlake system, right? So, however, we still believe in the growth prospects and potential of this technology company, and we are maintaining our accumulate with a revised target price of $1.02, which implies roughly about 50% upside, right? So next, I'll be handing over to my colleague Richard to share on SATS.
Hi, good morning. This is Richard speaking. So just to update you on SATS, SATS will be announcing their first quarter results tomorrow. But last Friday, they have already released their operating data for the Singapore Changi Airport business segment. So across the board, you can look at their operating metrics, and all of their operating metrics saw modest year-on-year growth. The thing to highlight, I have two things to highlight. First is their cargo handled. This was slightly stronger than usual at 4.9% year-on-year. And the other thing to highlight is their gross meals produced and unit meals produced metric. This year, they saw year-on-year growth. This is in contrast with the previous 4 quarters where there was actually year-on-year decline each quarter. This was due to Qantas bypassing Singapore from Australia to Europe. So this new year-on-year growth for the meals is in line with our forecast, and which we mentioned in our last report for the full year results for SATS. So currently we have a neutral rating with a target price of $3.05 for SATS, but subject to change again tomorrow after they release their first quarter results after the market closes. Now I'll hand over to my colleague who will speak on Ezion Holdings.
Hi, good morning everybody. Benjamin here. So let's do a company update on Ezion, which announced the winning of 2 service rig contracts last week. So the first contracts that they secured support at East European NOC in the North Sea. So the key thing is that Ezion will not be owning this service rig. So the contract value is about 122.6 mil, which translates about 48k day rate, okay, which will be provided over a 7-year period. And this one will be on a bareboat charter basis, which will be deployed in 2015 second quarter. Okay, the second contract that they have is to provide a new build for a Southeast Asian NOC as well. Okay, this one will be a leaf boat over a 5-year period, so it's a 3-year plus a 1+1 option. Right, so then the contract value is about 146 mil. Over the 5-year period, your day rate is about 80k. Right, time chartered. This one is on a time charter basis, different from the first one. So it'll be 2016 third quarter. Right, so just take note that for Ezion Holdings, this one we are still undergoing a change of analyst, so this one is still under review, right, for Ezion Holdings for rating. Okay, but our opinion is still quite positive on Ezion because of the strong demand for leaf boats that we are seeing, okay, which will be a key growth driver for Ezion going forward. Right, so some of the downside risks will be rising competition as well as gearing. Okay. Next up, we're covering on Kim Heng Offshore and Marine. So this morning we issued an initiation report. So for Kim Heng O&M, I'll be doing a full presentation on this in 2 weeks' time, right, after a public holiday next week. Okay, so just this one is just more of the key investment merits to keep you guys prepped up first before I give a presentation in 2 weeks' time. So for Kim Heng is an established integrated O&M value chain service provider, so they do mainly oil rig servicing. They were listed on Catalyst this year, I think sometime in January, 22nd January. So the activities there are 2 broad categories, one of which is offshore rig services and supply chain management. The other one is they do vessel sales and new build. So for this segment, it's been pretty quiet over the last few years, and offshore rig services has been doing quite really well. So 3 investment highlights that I want to draw your attention to. First of all, their business is very asset light, and we're seeing very high returns and strong operating and free cash flow generation as well. So gross profit margins and net profit margins are very high. Gross profit margin is quite stable, about 43% over the last 2 years, right? And net profit margins are quite good as well, about 22%. But because of that, we are seeing very superior returns on equity. But this one, this measure, is not that a good basis to look at it, because that was pre-IPO. So we look at investor capital instead, which will see the debt together with the equity, and we're seeing very superior returns over the investor capital. So because of that, they have been generating very strong and positive operating cash flow and free cash flow since FY 2010, which is the earliest financial data that they have provided. Right, so using IPO proceeds, they'll be expanding their yard facilities and so on and so forth. So once the capex cycle is over, we expect free cash flow to become very robust again, and that's where we will see very good potential for increasing shareholder returns. Right. And second one will be the high utilization rates and aging fleet. Okay, this one is more of a macro view. So currently, rig utilization across the global fleets of offshore drills are very high, right? Just together supported by the high oil prices of more than $100 per barrel, but it's keeping offshore activity very buoyant as well. So as for the aging fleet-wise, we look at the global jackups as well as the global floaters. So which are, we're talking about semi-subs and drill ships. 40% and 30% respectively are above 30 years old. Right. So together with the high rig utilization, it's unlikely that all these aging fleets will be scrapped. So because of that, these factors will be key demand drivers for Kim Heng's repair and maintenance services. Okay, because to keep the rig going and extend the useful life, they will need to go to Kim Heng to repair all their oil rigs, offshore oil rigs, when they pass by Singapore. Right. So last investment merit will be the Catalyst, which is the expansionary plans and potential turnkey projects that they might undertake. So currently, I say with the IPO proceeds, they are looking to expand their yard facilities to increase their capabilities to take in more rigs and projects. Right. And next up, for their acquisition plans, they are looking to acquire a subsea services contractor to complement the services that they're offering now for offshore repair. Right, so for this is the key driver they're looking at for the expansionary phase. So in terms of valuation-wise, Kim Heng is trading about 10% discount to its peers. So that's where you're looking at sizable companies like Mencas and MTQ, which is around the same market cap as Kim Heng. So it's really trading a discount to its peers. But on the other hand, its ROE and its return on invested capital is much more superior to these two companies, and they're still undergoing expansionary phase now. So therefore, based on these valuations, I think we are initiating with a buy call at 33 cents. So with today's share price, about 20% upside. Right. So the key thing to look out for coming up will be what kind of acquisitions they are looking to go towards. Okay. So now I hand over to Yong Kai to talk about the next part of the presentation.
Hi guys, it's Yong Kai here. I'm the US equities analyst. So about 2 weeks ago, I published this primary report on the oil and gas industry, primarily focusing on exploration and production. Okay, this is actually the upstream operations, and if you have seen the financials of the Exxon, you've seen the financials of Shell, even PetroChina, most of the earnings actually comes from upstream exploration. Alright, so this is where we're going to focus on today. Okay, so what we are going to do is an educational seminar for this. Okay, natural gas is actually a gaseous mixture of hydrocarbons. Okay, whereas crude oil is actually the hydrocarbons but is in the liquid phase in the natural underground reservoirs. And then they remain liquid and atmospheric. And they remain hold on. How do I have to speak? Okay, is this better? Okay, okay, if there's nothing else, okay, I'll just continue going. Alright, okay, so for this slide, right, what we need to bring attention is that there's actually two grades of crude oil, WTI and Brent. So what you commonly see in the media is that WTI will usually trade at a discount to Brent. It was actually as high as $27 per barrel a few years ago, but recently has narrowed to around $8 per barrel. Why? Okay, why? Because WTI is usually benchmark to it's actually a benchmark for US and Canada interior. Okay, so what happens is that there's a supply glut because of the oil production from shale formations. Whereas on the other hand, Brent is from Europe, Africa, Middle East. Especially Middle East right now, there is a risk premium attached to it. So Brent is priced higher, whereas WTI is lower, and this accounts for the pricing difference. Another thing is that tight oil and shale gas actually refers to hydrocarbons produced from shale formation. This tight oil is not to be confused with shale oil, even though the term is used very loosely. To be very strict, technically speaking, shale oil is kerogen, which is not crude oil and is produced from sedimentary rocks, whereas tight oil is crude oil that is produced from shale rocks. Next, typically we classify crude oil and natural gas commonly together as energy, but they are actually for very different purposes. Crude oil is mostly refined into gasoline, diesel, kerosene for jets, as well as naphtha. If you look at the above pie charts, 81% of the crude oil, the refined product, is actually used in transportation. On the other hand, natural gas is used in power plants. So we look at electricity generation, probably in Singapore, in Japan as well, and chemical feedstock, fertilizers, plastics, and residential heating. This accounts for why the price usually spikes in winter, because there's a higher demand for residential heating. Next, I want to bring to you about this differentiation between resources and reserves. Okay, if layman might not know the difference, but this is where I want to educate you on this. Resources, prospective resources is actually a very generic, a very broad umbrella. It covers potentially recoverable hydrocarbons that can be in undiscovered accumulations. So this is very broad. They can be undiscovered and potentially recoverable, and yet we classify them as potentially prospective resources. On the other end of the spectrum, we have proved reserves. So proved reserves, if you look at the slide right now, they are commercially recoverable under today's circumstances from known accumulations. And there is a 90% chance that their quantity produced is higher than estimates. Okay, so proved reserves have a very high certainty of production or being produced,
whereas prospective resources are very speculative. Crude oil is often discovered near producing areas because the similar environment, heat, pressure encourages its formation, and the geology, which is what the rocks are made up of, enables the entrapment. If the oil is not trapped, they might escape to the surface where they become, like say, your oil sands, and they will get degraded over time. Conventional reservoirs require sufficient depth for heat and pressure to turn it into crude oil, and then you have porous reserve rocks for it to be accumulated over millenniums. Typically, if the location oil has never been discovered, then there's a low 10 to 15% chance of discovering it. But where there is a known precedence, like say in Norway or in your Eagle Ford and Beckham Plates in the US, then there's a 50% or higher success rate. What happens is that usually there will be a few steps. Firstly, the producers will have a bid for the concessions that determines what's the boundaries and how many years they can drill there for, and whether there's any royalty rates attached to it. Secondly, they will have to conduct a seismic study to review the underground layers and map out the oil reservoir. Lastly, you have to drill. Drilling is the only way to confirm definitively there is a presence of crude oil or natural gas, and also to estimate the quantity based on the amounts and the pressure. The number of barrels of oil, for 1 barrel of oil, it's equivalent to 42 US gallons. 1 barrel of oil equivalents, otherwise known as BOE, is equal to the amount of energy released by burning 1 barrel of oil. Okay, so in this case, 1 barrel of oil is also equivalent to 6,000 cubic feet of natural gas. Okay, here's a catch. 1 barrel of oil doesn't sell for anywhere near the same price as 1 barrel of oil equivalents. Okay, why? So in this case, you look at as of 25th June, WTI crude oil sells for $100 plus per barrel. But 1 barrel oil equivalents, which is 6,000 cubic feet of natural gas, sells for only $27. So even though they are the same in terms of energy, but in terms of price, 1 barrel oil is roughly equal to 4 barrel oil equivalent of natural gas. Okay, what people usually think of is that whatever reserves I have, like mines, I can mine it entirely, but that's not true. Primarily, we just depend on natural pressure as well as artificial lift techniques, such as very simple pumps. You can only recover 10% of original oil. As the pressure is relieved, less oil flows out. You have to inject water or gas. You have to inject water or gas to displace the heavier oil and drive it to a production wellbore. So even then, only 20 to 40% of original oil is being produced this way. So lastly, we have to use EOR because up to 70% is still underground. EOR, enhanced oil recovery, uses thermal steam or gas injection. So this has a potential to ultimately extract 30 to 60% of the original oil, but it's much more costly and requires a higher oil price to justify a reasonable ROI. So we have shortlisted a few topics based on certain metrics that we've identified, and so as we screen through the bigger oil producers that have $10 billion market caps. So usually most people they just look at EV over per barrel oil equivalents, and then they will just use this to identify the attractive ones. But this doesn't reflect the composition. For example, you look at $20 EV per proved reserve. This might be cheap when 1 barrel oil sells for $100, but if the proved reserve is mostly natural gas, then $20 is actually a very high price to pay when the selling price is only $27, and this hasn't factored in any production costs. So if we weight this EV over proved reserve based on the selling price, then we have a clear winner: BP, Marathon Oil, ConocoPhillips, PetroChina, and Hess Corp. So what this metric essentially means is that you're paying less than $25 per barrel of oil equivalents for reserves that sell for around $100 plus. Okay, this metric, unfortunately, it doesn't factor in production costs and geopolitical risk. Why production costs? If a production cost is low, you can afford to pay higher for the reserves. But if a production cost, for example, oil sands, it might cost $60, $70 per barrel, then you might be better off. Then it doesn't mean much if your reserves are selling for only $10. Same for geopolitical risk. you will be naturally inclined to pay higher for US and Canada oil compared to, say, Africa or Middle East right now, where there's a lot of uprisings. Natural gas used to trade as high as near $14 per MCF. That was back in around 2005, but today it was trading at around $4 plus. Why? Because there's a supply glut coming from shale gas production. As a result, this is actually dampening the selling price in the US. Yet at the same time, your Asia LNG actually rose to $14 per MCF because your Japan, they've actually suspended all nuclear plants, so they have to depend on natural gas feedstock to power their electricity power generation. So what happens is that today in US it's $4, but in Asia you're selling for $14. Even if you factor in the $3 per MCF of LNG liquefaction and another $3 for shipping, there's still another $4 money left on the table, and this could mean a natural gas price convergence. So if you bet on a convergence, which means a higher natural gas price in US, you might want to look at these 5 companies: Southwestern, Cabot, EQT, Chesapeake, and Noble. Conversely, if you are bullish on crude oil fundamentals and you only want to look at those with highest crude oil reserves, you want to look at Marathon Oil, Murphy, Occidental, Chevron, and BP. So these 5 companies have the highest reserve mix in crude oil. Increasing production rates also generally translates into higher revenue growth and better economies of scale. But production decline might not be alarming because they could be due to asset divestitures. So companies with highest growth, in this case, they are Cabot, EQT, Range, EOG, and Noble. Lastly, dividend yields. Those buy-and-hold investors concerned with income stream will be interested in these yield plays because they are more predictable and rarely cuts. So in this case, we have BP, Total, Dutch, PetroChina, and ConocoPhillips. Once again, US dividend income is subject to 30% withholding tax rates. Lastly, I have some ending remarks for you. Oil and gas royalty trust, we excluded. Why? Because there's marginal production cost will increase over time. Unless you happen to find more reserves, which is unlikely given that you only have these exploration budgets, you have to pump in more and more money just to cost the same amount of production. And this is not comparable to real estate, where they have AEI, where they can raise their rental rates. Okay, this is actually a lot more subject to external influences, your market price for your oil and gas. At the same time, I want to highlight that traditional metrics such as PE and PB are less relevant because their value lies in their reserves, which is currently not revenue generating, and the carrying value for oil and gas, which is historical, could be development, could be acquisition. This has nothing to do with its actual worth. You might spend very little for the oil and gas reserves, but it can turn out to be bonanza. So as such, these are the top 5 shortlisted based on the different metrics. We are open for questions right now. Okay, so we have a question that this audience said that the companies mentioned is only an example of companies operating in this subsector of the bigger O&M universe. I think you're referring to oil and gas. Okay, wait, I'm not too sure. Okay, anyway, I'll just repeat the question from the very start. He's wondering whether Philip can consider doing a presentation on the oil, gas, and marine universe, explain the value chain and the companies that Philip is positive on. Okay, so this is something that we are definitely in the works. As you can see, this is the first step. We have really highlighted the upstream oil and gas exploration and production. So along the way, over the next few quarters, we might also, if we have the time, will educate our audience on the different subsectors of oil and gas. Sorry. Okay, we also have a question on TIH. So this audience here wanted to hear our perspective on TIH. We are after the full presentation last week. Okay, so if we understand correctly, TIH is actually Transpec Industrial Holdings, which have since renamed itself. Okay, for this company, right, historically it used to do very well. Why? It was a VC, so yes, a lot of private stakes which were not fairly valued. Since then, he has actually divested a lot of his private companies. is actually essentially a cash out right now with holdings in OUE. So that being said, now we look at it. Equity right today is around $110 million based on first quarter earnings, but its market cap is $300 million. So what does this imply? This implies that you are essentially investing in a cash cow with only $330 million, with only a $30 million stake in OUE, which has a book value of $110 million, and yet the market cap is $300 million. It's mostly divested as private equities again, so we don't see much more investment gains forthcoming in the near future. And we think that there is a good chance that TIH might be substantially overvalued right now based on a simple PB basis. Hi, okay, just give me a minute.
I have a question on OCBC, Benjamin here. Currently OCBC, as of our last report, target price is $9.74. Call is still neutral on it. Actually, we look at our estimations for OCBC going forward for the second half, and also of course including this current quarter, i.e. second quarter of this year. Actually, the core banking operations is still pretty strong. The net interest margin was up about 6 basis points in the first quarter, so we expect this to continue to trend down. 1.7% net interest margin is not really sustainable at this level, so we expect it to trend down to probably about 1.68%. Yeah. So then the outlook for the Q-on-Q wise, NIM is supposed to trend down as well, considering that they are not being able to price up on their loan use. So as a result of that, we might see slower growth from their net interest income side. The loans growth for year-on-year should be about 9 to 10%. Right. So again, the core banking operations still remain very strong. And I think something to watch out for this quarter is that the insurance side, which is the Great Eastern side, as well as their trading income, might come in as a surprise, considering that the yields have been coming down this quarter. So we might see some mark-to-market gains from here. Right. So, but OCBC again, we are still remaining quite cautious on it because of their Wing Hang Bank acquisition. Okay, now that there's Elliott Capital has come in and bought up almost close to 8%, that could be a potential roadblock for them to delist it. Right. On top of that, we are looking at most likely a rights issue as well to fund the acquisition. Right. So that's it from OCBC.
There's a question on Singapore LNG. What is Singapore plans moving forward, and any Singapore company we can look into? Okay, currently as far as we are aware, there's no listed companies in Singapore that's involved in the Singapore LNG plants. Okay, that being said, there's actually this natural gas LNG aggregator, BG Group. I think it's listed overseas, which you might look at it, and I think they have about 2 million tons per annum of they're actually this exclusive franchise. Okay, so this listed overseas, like what we say. So SGX listed, none that we know of as of the moment right now. Hi, there's another question on shale oil. So as you remember just now, shale oil is referring to kerosene. So kerosene is not crude oil. Okay, so what the audience is asking is that, do you reckon that shale oil, kerosene, they will substitute crude oil in the future due to technology enhancement available in the US? Okay, at the end of the day, both shale oil and crude oil, they are hydrocarbons, but shale oil is a lot more difficult to extract and currently uneconomical. Yes, it is possible that shale oil might be viable if the technology enhancement is available in the far future. And of course, the price has to increase to a level such that it justifies the extraction, because today shale oil production, kerosene is actually very minimal and insignificant. We have another question. Is this a recommendation to enter oil and gas now? Okay, oil and gas as of this presentation, we are not giving a clear direction on whether we're bullish or bearish about it. What we are saying is that if you have a certain, if you have a certain theme in mind, like say for example the oil prices going up because of the uprisings or because of natural gas convergence, then these are the stocks that you can bet on based on the metrics that we have identified and shortlisted.
Question on we compare Kim Heng with Porsche. Porsche seems to be lagging behind its peers like Pac Radiance. This is a little background first. Porsche and Pac Radiance are looking at offshore support vessel players, so it's a bit different from players like Kim Heng. Right, Kim Heng is more similar to Mencas and MTQ. So what they do is for Kim Heng, they are like a one-stop service point. Just think of it like a car workshop where when oil rigs pass by Singapore, right, they will go in and they will service the rig, do the clean out of the rigs, do retrofittings, change the parts for them, and so on and so forth. So this is the main core operations of what they are doing. It's very different from ship and asset builders like Porsche and Pac Radiance and Namjong, right?
Hi, there is a question on what is a good entry price for Silverlake and whether should we wait for a pullback, right? So we do observe that current share price of Silverlake maybe at a slight quite high price, although we are still bullish on the stock, given that there's a very excellent growth potential and how ASEAN, the banking industry, is gonna modernize and probably enhance and also possibly replace their core banking system. So we do see further upside to this, although it will probably be good to wait for a slight pullback in the price. And we, I would say roughly the price of $1.05 to a price range of $1.05 to $1.10 will be a good entry price, as this will based on those price range, it will also imply a more than 20% upside on our target price, right? Right. So apologies if it's too soft, right? So as I mentioned on the what's a good entry price for Silverlake axis, we do think that the price range of $1.05 to $1.10 will be a good possible price entry, right? As this will also imply that there will be a more than 20% upside based on our target price, and also we still feel very bullish on this stock.
Hi. Here's a question on SolarStream. Our previous rating on SolarStream was accumulate, meaning there was going to be a slight upside based on a lot of speculative merits, as well as decent, slightly above average valuation. Okay. So the rating on SolarStream now is there will be probably an update once they announce their quarterly announcements on the 30th of this month. So you can wait for that update. But at the moment, we think SolarStream has its fair share of bad news. All these news that it's all speculative. At this point, the news has not numbers driven in the sense, meaning that SolarStream has not shown that they are out of guidance for this year. But the negative news has been very speculative in the sense of political boycotts, for example, and a lot of speculation on what their growth rates might be in the US, etc. So all this speculative bad news has pushed the price down. What I will comment for SolarStream right now is that at the present price it is now roughly $30, I think. That's basically trading PE of 15 times, which I think even despite these negative news, 15 times PE for a company that will probably grow single digit this year and may recover to higher digit next year, that would be quite fair value, relatively inexpensive.
Hi, we have a question on whether there's any any recommendation on oil and gas stock listed on SGX other than MSC. As of the moment, we don't. Okay, primarily because I'm the US equities analyst, okay, and we don't have anyone covering oil and gas right now other than offshore and marine. Okay, that being said, if you realize a lot of these oil and gas stocks listed on SGX, they don't have proved reserves. Okay, I repeat again, they don't have proved reserves. They are all still at the exploratory stage. They are still drilling on the concessions to find out how much possible reserves they have. Okay, if you remember our presentation, which I'll just quickly highlight to you right now. Okay, a lot of these oil and gas companies on the SGX right now, they are all still at the prospective or contingent resources stage. Even if they have reserves, they have only proven it to the possible 3P, which means that there was only a 10% chance that the actual quantity is more than estimates. So as such, we got most of these oil and gas companies that are actually very speculative on SGX right now. Okay, so some of the houses, they say that, oh, you can apply a $20 per barrel, $20 per barrel onto your 2P reserves to come up with the numbers. But if you can get a less than $10 per barrel oil equivalents for your 1P, why do you want to spend more than $20 per barrel on your 2P? You get what I mean? Yeah, thank you. That's what we have for you today. Do join us for the next Monday's. Oh, sorry. Next Monday will be Hari Raya, so we will be having any webinars. So the next one will be on 4th August. Thank you.